Elon and Doge, we're kicking down the door, rolling to the SEC, time to settle the score. Elon in the game, breaking all the chains. Doge by his side, they don't play no games. Step into the SEC, watch them all sweat. We uncovering the fraud, ain't no secrets left. Naked shorts in the shadows, they've been creeping. Market manipulation, these crooks been sleeping. Retail's been trapped, but we bring in the fight. Musk and Doge on the rise, taking back the night. We hit the SEC, exposing the lies. Rooting out corruption, watch them meet their demise. Free the markets, make them fair once again. Elon and Doge rolling deep for the win. We see the dirty tricks they try to pull. Shorting stocks, playing games like a fool. But we too sharp, we calling the bluff. Elon's got the plan, now the pressure's tough. Retail investors, time to get your share. No more rig markets, no more despair. Fraud's going down, we taking control. Elon and Doge breaking out of the mold. We in the SEC, exposing the lies. Rooting out corruption, watch them meet their demise. Free the markets, make them fair once again. Elon and Doge rolling deep for the win. We on a mission, bring the truth to light. No more naked shorts hiding out of sight. Retail power, we reclaiming the street. Musk and Doge bringing heat to Wall Street. SEC, exposing the lies. Rooting out corruption, watch them meet their demise. Free the markets, make them fair once again. Elon and Doge rolling deep for the win. Hey, we on a mission, bring the truth to light. No more naked shorts hiding out of sight. Retail power, we reclaiming the street. Musk and Doge bringing heat to Wall Street. We the lion in the front, Doge holding it down. They can't stop us, we taking back the crown. Frauds uncovered, justice in our sight. Markets are free, we restore the light. Elon in the front, Doge holding it down. They can't stop us, we taking back the crown. Frauds uncovered, justice in our sight. Markets are free, we restore the light.
Welcome back, ladies and gentlemen. Butcher Wall Street here. Got some really important news because I see a lot of people are confused about the New York Stock Exchange, Texas, and the Texas Stock Exchange. These are two very different things. And the Texas Stock Exchange, well, let's just put it this way. It's being created by Larry Fink's BlackRock and Ken Griffin's Citadel Securities. So I think this should give you a little bit of an indication as to what exactly is going on with Texas Stock Exchange. They're trying to create a competitor to the New York Stock Exchange. The awesome thing is that the New York Stock Exchange, Texas, which is owned by the parent company ICE, who owns the New York Stock Exchange in New York, is actually strategically poised to address some of the systemic issues that we've seen in the equities markets. And they're really fighting hard and are pushing the SEC right now to allow them to basically stop naked shorting and market makers exemptions. This is a big, big deal where Texas Stock Exchange, backed by Citadel and BlackRock, appears very likely to want to perpetuate or exacerbate the problems we're currently seeing with naked shorting and synthetic share creation, artificially diluting companies, and manipulating your trades. So we're going to talk about this in depth I'm just going to give people a moment to hop in the channel here. What's going on, Lady Kim? It's great to see you. Welcome to the channel. Welcome back, I should say. We'll give people just a minute to hop in here. What's going on, Bacon? Ladies and gents, here's what's happening. You know what? Before I get started on that, I did want people to know that it looks like Paul Atkins and the Securities Exchange Commission are announcing positions for five candidates to fill board positions at the PCAOB, the Public Company Accounting Oversight Board. And the purposes of this are to appoint prominent individuals of integrity and reputation who have demonstrated commitment to the interests of investors and the public, and who have an understanding of the responsibilities for the nature of the financial disclosures required of issuers under securities laws with respect to the preparation and issuance of audit reports. So I will be moving forward and tossing my hat in the ring. I don't have any interest in working for anybody else, seeing as how I am the chief executive officer of my own businesses. Let me reset this really quick, since apparently my webcam has gotten stuck. But that does not mean that I don't think it would be a good idea to actually try to create the change that we need, not only through the creation of a new stock brokerage firm, Lit Exchange, but also from within the Securities Exchange Commission itself, by allowing myself to help with the relaying the interests of the public and retail investors. I think that that is extremely important as well. In case you guys are unaware, New York Stock Exchange is now officially open for business in Texas. They have become the first securities exchange to operate in Texas, and they have launched with DJT, the first new company to join through listing on the NYSE Texas. And what they're actually doing here is working very hard to eliminate the issues that we're seeing with the Bernie Madoff exception, which is market makers exemption that allows them to sell shares of stock that they don't own in the name of liquidity. You guys may have seen Doug Sifu and Ken Griffin talking about this multiple times in the past, and they consider themselves to be liquidity fairies because they can sell stocks they don't own out of thin air and artificially dilute the companies when they fail to deliver. You receive them in your account, but the shares should never actually be in existence. So let's dive into this and figure out what's going on here, because a lot of people are wondering, when I mentioned the New York Stock Exchange, Texas, they're like, no, we don't want anything to do with BlackRock and Citadel. I know, and neither do we. That's why Lit Exchange is not going to be routing orders directly to the Texas Stock Exchange, where orders will be likely manipulated and routed into dark pools using payment for order flow. However, New York Stock Exchange, Texas, which is being launched by ICE, the same company who runs the New York Stock Exchange, is ready to end market maker exemptions and provide real-time quote auditing and cross-market surveillance and increase enforcement against excessive naked short selling. Whereas the Texas Stock Exchange, under BlackRock and Citadel, are likely to enable the internalization of retail orders and limit quote competition. There's a high likelihood of dark pool reliance here and payment for order flow, which is repeating the very issues that are currently harming retail investors. Not to mention, they have not clearly confirmed if they will do anything to help retail investors, whereas the New York Stock Exchange, Texas, has already stated that they're going to be working very hard and have already filed with the Securities Exchange Commission to do a lot of things to end naked shorting. And I'll explain that right now. Let's jump right in, right? Let's not waste any time. So here's what can be confirmed from the official New York Stock Exchange, Texas rulebook. and related filings. We are talking the backers, the parent companies of the New York Stock Exchange versus BlackRock and Citadel, right? Obviously, something very important here, as anytime you have Charles Schwab, Citadel, and BlackRock working on something together, I think it's pretty fair to say that payment for order flow is going to be at the forefront. Dark pools are going to be at the forefront because Charles Schwab is the #1 recipient of payment for order flow from Citadel Securities and other market makers. #1. Robinhood is right there behind him. And we're talking anti-manipulation versus anti-regulation. The New York Stock Exchange, Texas, has drafted rules that are being currently reviewed by the Securities Exchange Commission that will require market participants to secure or pre-borrow shares before executing any short sale. Currently, the Texas Stock Exchange and on the current New York Stock Exchange, there is something called no pre-borrow requirement. All they have to do is locate them under Reg Show. And under the New York Stock Exchange, Texas, this would not be an advisory, but it would be a firm requirement. And this is clearly aimed at preventing naked shorting. Anytime you've got locates, you've got a situation where the market maker could be borrowing shares that may not actually exist or may have already been lent out 2, 3, 5, 10 times by the broker-dealer. That's what happened with companies like AMC, GameStop, SLV, COS, etc. back in 2021 when they were made position close only. There was so much naked shorting going on in these stocks that the market makers, the clearinghouses, the brokers would have all collapsed had they had they actually had to deliver all those shorted shares. That's why retail investors were no longer able to buy them. So these firms colluded and stole billions and billions of dollars from millions of retail investors to save their own ass. And because they did not have pre-borrow requirements, all they had to do was locate the shares. That meant, for example, Charles Schwab could lend out the same share of, let's say, SLV ETF over to Citadel, and then that same share could be loaned out to BlackRock and Chase and Bank of America and Goldman Sachs, etc. But that won't be the case anymore. Now we've got market maker exemptions, right? There will be no market maker exemptions under the New York Stock Exchange, Texas, if the Securities Exchange Commission goes ahead and passes these requested rules. That means no naked shorting, no legalized naked shorting. Right now on the New York Stock Exchange and under the TXSE, Texas Stock Exchange by Citadel and BlackRock, which has not launched yet, is set to launch in 2026. But it looks like they will be allowing market maker exemptions via Reg Show, which is also known as the Bernie Madoff exception for those of you that don't know. This allows somebody like Citadel to sell you shares that they don't have. And if they don't buy them back up to, a month plus later, they're simply chalked up as a failure to deliver. Now you have shares in your account that shouldn't even exist beyond the number of stocks and shares that are actually available in that company. But that will not be the case under the New York Stock Exchange, Texas, if the SEC goes ahead and allows these regulations to move forward. So there's also going to be a hard closeout on FTDs, right? The NYSE Texas rules incorporate a mandatory closeout deadlines tied to a T+2, which is 2 trading day plus 2 settlement schedule, or faster. It could be T+1, it could be T0 the same day, but they are going to have an immediate hard closeout rule. And brokers must automatically close any failure to deliver, and they are prohibited from executing shorts until those FTDs are resolved. This is called auto blocking. And of course, under TXSE by Citadel and BlackRock, that is not showing to be the case whatsoever. Under the NYSE Texas, brokers will be and market makers will be prohibited from executing shorts until those failures to deliver are resolved. This will greatly reduce errors in the consolidated audit trail, the CAT system. It will greatly reduce the number of failures to deliver on stocks. It will greatly reduce the number of synthetic shares created. But we actually need firms, brokerages, to route orders to the NYSE Texas. But if firms like TXSE are paying for order flow from companies like Charles Schwab, Robinhood, Webull, IBKR, etc., well then, they're going to route to them because they're going to pay more. Whereas Lit Exchange, the upcoming stock and crypto brokerage that we are currently creating and is scheduled to launch beta in Q4 of this year, is going to be routing orders directly to lit markets. This obviously saves retail a lot in losses on bid-ask spreads, and I'll get into that more a little bit later. But eliminating the market maker exemption, unlike existing exchanges where market makers enjoy these exemptions under Reg Show, the NYSE Texas will apply their pre-borrow and FTD rules to all their participants. That includes broker-dealers, that includes market makers. And so the rule doesn't explicitly name market makers. There will be no carve-outs for them. The market maker exemption rule 203BI, which allows them to sell shares of stock that they don't have, will not be allowed. And of course, there will be surveillance, transparency, and penalties that are enhanced. Although the Form 1 that has been filed by the NYSE Texas and the rulebook don't detail their exact surveillance tech, the NYSE Texas's rule filing emphasizes exchange-level real-time monitoring. This is not something that's currently available on the New York Stock Exchange in New York. And automatic penalties for rule breaches. Automatic penalties. This is huge, folks. This is obviously reflecting of a tighter model than what we're currently seeing based on the SEC enforcement, SEC and FINRA enforcement that we're currently seeing that operates after the fact time and time again, and allows these market makers to sell these shares of stock and commit these violations, and oftentimes they just get a tiny slap on the wrist. So it's going to be a lot faster and a lot stricter than the current SEC and FINRA enforcement pipelines. Now, continuous public reporting, lit markets, folks, versus Citadel-aligned high-frequency arbitrage venues. And in case you don't know what that means, I'll explain it. The New York Stock Exchange proposal includes provisions for continuous public disclosures of FTD's failures to deliver and aggregate short interest. That means they won't just be reporting it twice a month like they currently are. Market makers and brokers won't be reporting short interest twice a month. They'll be doing it continuously, and it'll be continuously disclosed to the public. This is obviously ramping up transparency compared to the periodic reporting that is currently mandated by the SEC, which is only twice a month. CRXV says, better get ready, boss. A lot of accounts will be transferring to Lit Exchange. Who would ever want to use TXSE? You are absolutely right, my friend. We are ramped up, and our engineering development team is more than ready to accept millions and millions of users at Lit Exchange as soon as we launch next year. Of course, the beta does begin this year in Q4. We are scheduled to launch a beta of Lit Exchange for all founding investors. Founding investors being those that have so far invested in the company, so that we can get everything tested out and make sure that it's perfect. So when we have millions of users pouring in who are trying to leave their shit brokerages over at Robinhood and Schwab and et cetera, to avoid payment for order flow, to avoid dark pools, to avoid market manipulation, to avoid their trades getting front run, to avoid synthetic shares, I could go on, but I think you get the point. Educated retail investors will want to go a place with high yields in their cash sweep, with high yield accounts, and who also are not being front run every chance they get, and their orders are not being sold to the highest bidding dark pool, which is currently what you're getting at your brokerage. CRXV is a founding investor too. Congratulations on your investment in Lit Exchange, and thank you, my friend. I look forward to partnering with you and working with you along with our engineering team during beta here in Q4. Now we're talking penalties. This is the good part. Expulsions. When have you ever heard the word expulsions as a penalty before? Not in the United States. We've seen it happen in Korea, in India, right? But not here in the U.S. Finally, the rule book that NYSE Texas is pushing grants them the power to impose escalating penalties from fines to trading suspensions and even revoking privileges of companies like Citadel and BlackRock and others for entities with persistent delivery failures. And that goes much further beyond the typical slap on the wrist penalties we've seen happen for decades here in the U.S. I'm literally talking decades, folks. We have learned so much over the last couple decades since the 2008 crash. And that can was kicked, and here we are with a lot of the same exact things happening. Dodd-Frank regulations did not do enough to actually help retail. They just gave further loopholes and exemptions, such as the market maker exemption and so on. And now with the tokenization of securities, we've seen that a lot of these tokenized securities aren't even backed by the assets they claim to be. And that was proven via the collapse of multiple exchanges. For example, FTX, who claimed to hold millions of shares, hundreds of millions of shares of GameStop and hundreds of millions of shares of AMC and many others. And we found out that when they went insolvent and we got to look at their books, they didn't hold a single fucking share of those companies. That means that they were lending out shares of stock through tokenization that they didn't own, that they didn't have any assets backing them. That means that companies like Citadel and BlackRock and Bank of America and hedge funds and family offices were able to borrow shares that didn't exist in order to short them. That is why the locate requirement is such a big deal, because at that point they could just locate these tokenized securities and short them, even though they weren't backed by anything, versus the anti-manipulation of the NYSE Texas, which Lit Exchange will be routing orders directly to, will prevent, because they won't be able to just locate them. They'll actually have to pre-borrow them. And if those shares are already lent out to somebody else, they'll be in somebody else's books, and they wouldn't be able to be lent out again. That is obviously a big deal. So we've got the locate requirement versus the pre-borrow before shorting. And then right now you've got no market maker exemptions. The same rules apply to everybody. No naked shorting legalized versus the Bernie Madoff exception, in which reg show carve-outs allow market makers to do so. So pre-borrowing essentially eliminates naked short sales by leaving no margin to execute these unbacked trades. And universal coverage ensures that market makers cannot exploit loopholes. Real-time enforcement. Okay, real-time enforcement is going to help catch and deter violations before they escalate. And then the public failure to deliver reporting is going to increase visibility into market activity. And this is going to make the phantom share creation and the synthetic share creation issues harder to hide. So people will be able to see when they're happening and understand that this stock is likely to go through the roof, or this stock has been naked shorted more than it should have been and is likely to require closeouts, because it will be mandatory, immediate, hard T+2 closeouts or sooner, along with auto blocking of those market makers' trades if they don't do so, because it will be implemented by the NYSE Texas. So if this is fully implemented and approved by the SEC, which these rules have already been presented to them and are currently under SEC review, they would indeed make the NYSE Texas amongst the most stringent United States exchanges with regard to naked short selling. So here's a little note on the pending approval. All of these features for NYSE Texas are proposed in the NYSE Texas's draft rulebook, and the formal adoption of them requires the SEC approval via public filing of NYSE Texas rule changes. Okay, these are called 19B-4 filings. So you can Google that if you want. NYSE TX 19B-4. Now, this is expected but not yet official, that these measures will become enforceable once approved. But we have seen them in the past approve other lit exchanges and other lit markets. For example, IEX, called Investors Exchange, about 10 years ago. They were approved. And of course, Citadel opposed them at the time. And the SEC said, Citadel, you're out of your fucking mind. This is a great idea. We don't care if you lose some market share. And they have indeed lost a tiny bit of market share, but not enough. Not enough, because most of the brokerages like Schwab, Robinhood, etc., all the payment for order flow brokers, which is almost every single broker in the country, is routing orders to the highest bidder, the highest bidding dark pool, which is usually Citadel, because they can pay more, because they can front run your trade and make sure that they can fail to deliver on it if they have to. Scott, what is the time frame on lit reaching out to investors? My friend. Well, you can invest now if you'd like. The crowdfunding campaign does end on August 9th of this year. The crowdfunding campaign ends on August 9th of this year. So far, over 400 plus retail investors have invested nearly $1 million, and we are this close to reaching our stretch goal. That is going to close on August 9th of this year, so in just a couple of weeks. Or if we reach our goal before August 9th, it will then close sooner if we reach our maximum goal. So that is to give you a little bit of an indication. Now, in case you're wondering, Lit Exchange is a fintech company founded in September 2021 to empower retail by developing the world's best stock and crypto trading website and software for desktop, iOS, Android, etc. And unlike traditional brokerages, we're prioritizing fairness and transparency in financial markets. We aim to automatically route orders directly to lit markets and avoid dark pools to prevent manipulation of your trades and of your stocks. Beta testing is set up for this year, folks. You can join the waitlist at litexchange.com, also litexchange.app, multiple domains available there. You just input your email there. No other personal information is required. Now, in case you guys didn't know, we've run multiple polls on this, and over 91% of people said they would be interested in paying a very small commission versus the hidden fees and worse pricing that they're receiving from payment for order flow brokers. The Securities Exchange Commission sued Robinhood and found that their users paid over $34 million more in commission-free markups. There's no such thing as commission-free. Just because you're not paying just because you can't see the commission doesn't mean that you're not actually paying it. And Robinhood was fined $65 million for losing you $34 million more than if you would have just paid a few pennies or a few cents up front. It's really that that simple. Robinhood takes a user's stock order and sells it to a larger trading firm, Citadel, for example, that executes the trade through payment for order flow. While Robinhood markets its services as commission-free, the SEC claims that customers in reality received inferior trade prices that, in aggregate, that means total, combined, deprived customers of $34.1 million, despite any savings they received from paying zero in commissions. That means that even accounting for what those brokers were charging at the time, which was $5 a trade, retail investors lost $34 million more through this commission-free trading. There's nothing in life that is free, and commission-free trades still have a cost. Okay? Not only do you end up losing more money through terrible hidden fees, but then Citadel can front-run your trades. All these market-making wholesalers, all these dark pools can front-run your trades, slap your order together with many, many others and process it through a dark pool combined with others to prevent the stock that you're buying from actually going up in price in the way that it should. See, because Robinhood failed to seek to obtain the best reasonably available terms when executing customers' orders, causing customers to lose tens of millions of dollars. These brokerages like Schwab and Robinhood have no interest in giving you the best prices. They only have an interest in making as much money for themselves as they can. So you might end up paying significantly more for every single share that you just purchased, costing retail millions and millions of more dollars. That is obviously a big problem. But I digress. Let me go back here. Your wife's boyfriend, that is incorrect, my friend. It is not about 1 cent per trade with Robinhood. You could not be more wrong. The fact is that the hidden fees and spreads are so large that you have no idea if every single share you're buying is costing you 1 cent more, 10 cents more, 15 cents more, 35 cents more. That is why the Securities Exchange Commission found that retail investors literally lost $34 million more. $34 million more than they would have had they just paid $5 per trade. As the SEC's order finds, and Robinhood agreed and paid the $65 million fine. One of Robinhood's selling points to its customers was that trading was commission-free, but due in large part to its unusually high payment for order flow rates, Robinhood's customer orders were executed at prices that were inferior to other brokerages' prices. Despite this, Robinhood falsely claimed in a website FAQ that its execution quality matched or beat that of its competitors. The order finds that Robinhood provided inferior trade prices that deprived customers of $34.1 million. This is not up for debate, my friend. Of course, Robinhood agreed to a cease and desist, prohibiting it from violating the anti-fraud provisions and record-keeping provisions, censuring it, and requiring it to pay $65 million in penalties. But guess what? Now Robinhood doesn't have to pay this anymore because in the fine print, it says when you sign up for Robinhood that you are using payment for order flow, and you may be losing more money than if you just paid a few pennies or a few cents up front. That is absolutely huge. Absolutely huge amount of money. So I think I've made the point here. Chris, congratulations on your gains, my friend. I know small cap biotech stocks right now. It is squeeze time right now. A lot of meme stocks are squeezing, and we're in for some volatility in the coming weeks. That's for damn sure. But really quick, bettermarkets.org. Check this out. I'm just going to skip forward here. The SEC found that they lost $34 million more retail investors from Robinhood's order execution practices compared to what they would have received at other brokers, even after accounting for the $5 per trade commission that those other brokers charged. Now, I'm not in any way implying that Lit Exchange is going to charge $5 per trade, but the other brokerages at the time when this was issued were charging $5 per trade for large trades. And even accounting for that, retail still spent that $5 plus $34 million more. There's no free lunch, folks. And in case you didn't know, Bernie Madoff, the Ponzi scheme king, is the one who decided he could make a nice profit by convincing brokers to route their trades and their order flow to his firm for execution. So that was lucrative for brokerages, and it still is. Because these high-frequency trading firms that buy those orders and make money by collecting the spread between what they are willing to buy a stock for and what they're willing to sell the stock for has proven harmful for investors and markets, creating a massive conflict of interest for brokers who are obligated to seek the best execution of client trades. But if brokers are selling their orders to the highest bidder, can they really be expected to seek best execution? And of course, that was best exemplified by their SEC enforcement action against Robinhood, because instead of being commission-free, it is not the same as cost-free. This practice transforms what is supposed to be an upfront cost, a fixed cost, into a hidden variable cost in which you could be paying significantly more than just paying upfront, a small, tiny amount. That's from bettermarkets.org, folks. You can check that out there as well.
First, FTX burned down, and now your stock brokerage is on fire, and not in a good way.
It's time for change. Lit Exchange. No dark
Become a
pools,
founding member
no
now.
restrictions, no bullshit.
And avoid the bullshit. Avoid the
Bro,
dark
what
pools.
happened? I was rich, but then my brokerage restricted trading and I lost it all.
It's time for change. Lit Exchange. No dark pools, no restrictions, no bullshit.
You know what? I will show this to you briefly in case you guys are unaware. If you didn't already know, the whole point of Lit Exchange offering retail investors the ability to invest in the company is because no other stock and crypto brokerage startup has ever done this in the history of the world. There are plenty of venture capital firms and hedge funds and family offices that we can go to for money. But we want retail investors the chance to own the company instead of these massive firms. And you can have first dibs. Because this company is for retail, by retail, investors are going to receive equity, shares, and benefits, perks, designed exclusively for this early round that ends August 9th of this year, that will never be offered once this raise is officially ended. Lit Exchange has applied for NASDAQ ticker reservation because the company is pursuing IPO. And this would, of course, create exit opportunities for investor returns, a liquidity event. Cheers, my friends. I'll leave it at that. And you know what? We may even apply for a New York Stock Exchange Texas ticker reservation, especially considering we are going to be right here. We are here in Dallas, Texas, and we are currently hiring a lot of people. In case you're wondering, we are hiring customer service reps, financial analysts, financial professionals, engineers, developers, front and back end. You can find more information about that on our on Indeed.com. You can find more information about those job listings on our X profile at Lit Exchange app, in case you need to or would like to apply, I should say. And if you're not already, I'll just pull up my profile, make things a little bit quicker to get there. You can follow Lit Exchange app on X as well. And watch out for fake accounts of myself and, at Boss Blunts 1 on X and Lit Exchange as well. You will notice that I have not only a blue check mark, but I am also an affiliate of Lit Exchange. There's also a Lit Exchange logo. Let me close this stuff out. Got too much stuff going on here in the background. Just going to refresh this. Thank you, Lady Kim. Tyler, your wife's boyfriend. You are absolutely correct, my friend. Nothing is going to stop Lit Exchange. Nothing. You see this icon? No fake Boss Blunts account, which there are thousands. It is ridiculous how many there are. None of them will have this except for myself, the real account at Boss Blunts 1. And when you click it, it will take you directly to Lit Exchange. There are hundreds of Lit Exchange knockoffs, like fake accounts as well, trying to trick people. There is no doubt about it that there is a gold check mark here. None of the others will have the gold check mark because this gold check mark costs $10,000 a year. So if you find Lit Exchange and it doesn't have the gold check mark, you know you are at the wrong one. At Lit Exchange app is the Twitter handle. You can see some of our job positions here. Software engineers, customer support specialists, 1, 2, and 3. We are located in Rockwall, Texas, and are opening our offices here with additional locations opening around the country in the near future as well. So, ladies and gentlemen, I just wanted to bring that to your attention. Should you decide to put in your application, I urge you to do that because we do look after our own, and I do want to hire people from the community, from the retail investor community, before anybody else, because you, ladies and gentlemen, understand how financial markets work more than customer support specialists from outside the industry, for example. Already in like Flynn, 4 units in the bank, says Patty. Patty, thank you very much for being one of our founding investors and an owner of Lit Exchange. Cheers, partner. Thank you very much. All right, folks, this stream has gone on long enough. I think I'm going to cut it there. I wish you peace and wealth. Have a beautiful rest of your day. I will see you guys on the next stream. Cheers.